Most drivers do not see a refinery closure directly. It does not appear on a gas station sign. It does not show up as a line item in a household budget. It does not announce itself when a family fills the tank, buys groceries, or drives to work. The effect moves through the fuel system before it reaches the household. A closure can reduce local production capacity, shrink the supply cushion behind gasoline, diesel, jet fuel, and other refined products, and make a region more dependent on replacement supply. When inventories are lower, drivers can feel the result through pump prices and a household budget with less room. The company is not the center of the story. The people at the end of the fuel system are commuters, parents, small business owners, and families that depend on stable fuel costs, predictable deliveries, and affordable transportation. Refineries matter because they turn crude oil into usable fuels. When refining capacity leaves the system, fewer domestic barrels are available from that source. If consumption continues and inventories fall, the market has less cushion. EIA explains that inventory withdrawals tend to increase wholesale and retail fuel prices because market participants must meet demand by competing for a smaller pool of refinery production. That is how refinery closures can become consumer consequences. In March 2025, EIA reported that inventories of the three largest U.S. transportation fuels, motor gasoline, distillate fuel oil, and jet fuel, were forecast to fall in 2026 to their lowest levels since 2000. EIA connected that forecast to two pending refinery closures and growing consumption. The forecast placed ending inventories for those three fuels at 375 million barrels by the end of 2026. The comparable low point was 358 million barrels at the end of 2000. Those numbers describe a fuel system with a thinner cushion for drivers. That cushion matters because it sits behind the pump price. When inventories are stronger, the market has more room to absorb disruptions, regional pressure, and shifts in demand. When inventories are thinner, the system has less room before price pressure reaches consumers. That is the broad national context. The clearest example is on the West Coast, especially California. EIA reported on July 9, 2025, that California was set to lose 17% of its oil refinery capacity over the next 12 months because of two planned refinery closures. EIA said that, if realized, those closures were likely to contribute to increased fuel price volatility on the West Coast. The two facilities were the Phillips 66 Wilmington Refinery in the Los Angeles area and the Valero Benicia Refinery in the Bay Area. EIA listed the Wilmington Refinery at 139,000 barrels per day and the Benicia Refinery at 145,000 barrels per day. Nationally, those two refineries represented less than 2% of current U.S. refining capacity. Regionally, the picture was different. EIA said they accounted for 17% of California refinery capacity and 11% of West Coast or PADD5 capacity. That difference is central. A refinery closure can look small on a national chart and still be large for the region it serves. A driver does not buy gasoline from the national average. A driver buys from a local market shaped by regional refining capacity, fuel logistics, distribution routes, imports, and available inventory. California is especially sensitive because of how its fuel market is connected, EIA said. California usually has higher retail gasoline prices than the national average, partly because the West Coast has relatively limited logistical connectivity to other U.S. refining hubs, such as the Gulf Coast. EIA also said the supply shortfall left by the Los Angeles and Benicia refinery exits is likely to have an outsized impact because it cannot be easily filled by other refineries elsewhere in the country. The chain is direct. Refinery capacity leaves the region. Local production becomes smaller. Replacement supply becomes more important. Imports and outside sourcing carry more weight. The regional fuel cushion becomes thinner. Price volatility can increase. Drivers face a market with less room for disruption. This is not the same as saying every closure immediately creates a shortage. The companies said they would seek replacement supply. Phillips 66 said it remained committed to ensuring a steady fuel supply to meet ongoing California consumer demand and expected to meet demand by sourcing gasoline from within and outside its refining network. Valero said it remained committed to fulfilling contractual supply obligations in the California market and anticipated importing additional gasoline volumes to the Bay Area in the near term. Those statements provide balance. The verified issue is not that gasoline disappears the moment a refinery closes. The verified issue is that local refining capacity declines. The region depends more on other supply sources, and the market can become more exposed to volatility. EIA identified likely replacement fuels as imports from Asia, especially jet fuel and gasoline. EIA also noted that California's unique gasoline blend stock, CARBOB, can only be made by properly equipped refineries. Fuel is not always interchangeable. California's gasoline market has specific requirements. If replacement supply depends on properly equipped refiners and longer supply routes, the system may have less flexibility than a region more closely connected to other major refining centers. Arizona and Nevada are part of the same regional story. EIA said those states receive fuel shipments from California refiners and are likely to be affected by reduced regional supply. That means the impact does not necessarily stop at California's border. A refinery closure in one state can matter to neighboring markets if those markets depend on fuel shipments from the same refining system. Phillips 66 provided an update on October 1, 2025, saying it was progressing toward idling operations at its Los Angeles refinery. The company said the facility had received its final waterborne crude shipment on September 30, 2025, and that final crude processing was expected around October 16, 2025. Several process units had already been placed in an idle state, and Phillips 66 said the remaining units would be idled in phases through the end of 2025. For the company, this was an operational transition. For the region, it meant the loss of a 139,000 barrel per day refinery in the Los Angeles area. When a refinery stops processing crude, a local source of refined fuel output is reduced. When local output is reduced, replacement supply has to come from somewhere else. If replacement supply is harder to source quickly, the region has less flexibility. If inventories are also tightening, drivers can become more exposed to price movements. Phillips 66 also said it expected to record approximately $70 million in environmental expenses in the refining segment related to future groundwater mitigation plans, plus approximately $30 million in an asset retirement charge in the midstream segment, related to transportation assets that would no longer be used as a result of the idling. Those numbers show that refinery closures involve more than stopping production. They can affect transportation assets, environmental obligations, and the surrounding fuel infrastructure. For drivers, the financial charges themselves are not the main point. The household impact comes from the supply chain result. Fewer local refining barrels and a greater need to source fuel from elsewhere. Valero announced on April 16, 2025, that its subsidiary, Valero Refining Company California, had submitted notice to the California Energy Commission of its intent to idle, restructure, or cease refining operations at the Benicia refinery by the end of April 2026. Valero CEO Lane Riggs said, "We understand the impact that this may have on our employees, business partners, and community, and will continue to work with them through this period." That quote acknowledges that a refinery shutdown reaches beyond a balance sheet. It affects employees, business partners, and the local community. A refinery is not just a company asset, it is part of a regional economic system. Valero also said it recorded a combined pre-tax impairment charge of $1.1 billion for the Benicia and Wilmington refineries. Included in that amount was the recognition of expected asset retirement obligations of $337 million as of March 31, 2025. In its January 2026 refinery page update, Valero said it would proceed with idling through a phased approach, starting with processing units in February, because required mandatory state inspections could not be deferred. The company said the refinery would continue producing gasoline as it worked down inventories, but expected most refining process units to be properly idled by April. Argus reported on April 30, 2026, that Valero had stopped producing fuels at its 145,000 barrel per day Benicia refinery. Argus quoted the company as saying it had ceased operation of the fuel production units after idling processing units in phases during the first 3 months of 2026. The sequence moved from notice to phased idling to stopped fuel production. For the fuel market, the effect was capacity leaving the system. For households, the effect was a thinner regional supply cushion behind the fuels they depend on. The Benicia refinery was not only a gasoline facility. Valero's refinery profile listed the facility at 170,000 barrels per day of throughput capacity, with more than 400 employees. Valero said the refinery produced CRBO, B gasoline, diesel, CRB, diesel, jet fuel, and asphalt. It also said the refinery accounted for 10% of CRB gasoline used in California and 25% of CRB gasoline used in the San Francisco Bay Area. Valero also said Benicia accounted for 45% of asphalt supply in Northern California. Those details broaden the consumer impact. A refinery closure is not only about one fuel grade at a gas station. It can affect gasoline, diesel, jet fuel, asphalt, and regional supply chains. Gasoline affects drivers, diesel affects freight, jet fuel affects aviation, asphalt connects to road work and construction. The refinery sits inside a larger network of everyday economic activity. The loss of Benicia and Wilmington capacity fits into a longer West Coast pattern. EIA listed Marathon's Martinez refinery closure in 2020 as part of the continuing trend of decreasing West Coast refinery capacity. EIA also identified the end of petroleum refining operations at Phillips 66's Rodeo refinery in early 2024 as part of that trend. In October 2024, EIA said Phillips 66 announced plans to close its 139,000 barrel per day Wilmington refinery in the Los Angeles area. In March 2025, Valero approved a plan regarding Benicia operations and later stated it intended to cease refining operations by the end of April 2026. On March 3, 2025, EIA published its analysis, forecasting that inventories of motor gasoline distillate fuel oil and jet fuel would fall to their lowest levels since 2000 and 2026. On April 16, 2025, Valero formally announced notice to the California Energy Commission. On July 9, 2025, EIA reported that California was set to lose 17% of refinery capacity over the next 12 months because of the Phillips 66 and Valero closures. The pattern is not one isolated facility, it is a sequence of refinery capacity, leaving a region where replacement supply is harder to move in from other U.S. refining hubs. That sequence matters for drivers because fuel prices are shaped by regional systems. A national refinery statistic can hide local vulnerability. A closure that appears small nationally can carry more weight in a region with limited logistical options. The West Coast case shows that clearly, less than 2% of U.S. refining capacity can still represent 17% of California capacity and 11% of West Coast capacity. For a family in the affected region, the national percentage is not the lived experience. The lived experience is the local gasoline market, the local diesel market, delivery costs, commuting costs, and the price volatility that can appear when regional supply becomes tighter. The current market context shows why this matters. EIA's weekly petroleum status report for the week ending May 8, 2026, was released on May 13, 2026. Reuters reported that U.S. crude inventories fell by 4.3 million barrels to 452.9 million barrels. Gasoline inventories fell by 4.1 million barrels to 215.7 million barrels. Crude exports rose by 742,000 barrels per day to 5.49 million barrels per day. Gasoline exports rose to 1.05 million barrels per day. Refinery utilization was 91.7%. Those numbers show a fuel system where refineries were still running at high utilization but gasoline inventories were still falling. That condition matches the broader thesis. The question is not only whether refineries are operating, it is whether the system has enough cushion after production, demand, exports, imports, and regional movement are counted. AAA reported on May 7, 2026, that the national average for regular gasoline had risen 25 cents for the second consecutive week to $4.55 per gallon. AAA said pump prices were $1.40 higher than 1 year earlier and had reached their highest levels since 2022, when the national average peaked at $5.01 per gallon. That is where the refinery story reaches the driver. A refinery closure is an upstream event, far from most households. When local capacity is reduced, inventories are lower, and replacement supply is harder to source. Pressure can move through wholesale markets and retail prices. EIA stated that inventory withdrawals tend to increase wholesale and retail fuel prices because market participants must meet demand by competing for a smaller pool of refinery production. That sentence is the bridge between industry data and household economics. Refinery closure leads to reduced production capacity. Reduced capacity can contribute to lower inventories. Lower inventories mean market participants compete for a smaller pool of refinery production. That competition can increase wholesale and retail fuel prices. Higher retail prices land on drivers and families. The human impact is practical. A higher pump price raises the cost of commuting. It raises the cost of school transportation. It affects errands, appointments, and weekly routines. Diesel and other refined fuels affect freight and goods movement. Jet fuel and asphalt show that refinery output touches more than the family car. A middle-class household may not know which refinery supplied its market. It may not know whether replacement fuel came from another refinery, an import, or a regional shipment. It knows when a tank costs more to fill. It knows when delivery and transportation costs are harder to absorb. It knows when the monthly budget has less room. The refinery is not the protagonist. The household budget is. There is also employment and community impact. Valero said the Benicia refinery had more than 400 employees. Lane Riggs said the company understood the impact the decision may have on employees, business partners, and community. That means the closure has two paths of consequence. One path runs through fuel supply, less refining capacity, a thinner supply cushion, more import dependence, and more exposure to price volatility. The other path runs through the local economy, employees, business partners, and community connections tied to the refinery. The verified research does not support unsupported claims about job losses beyond what the sources state. It does support the basic point that Valero acknowledged impact on employees, business partners, and community. For a town or region, that matters because large industrial facilities are often connected to many layers of economic activity. The facility employs people, it buys services, it supports business relationships. When operations are idled or ceased, the impact can extend beyond the fence line. The main consumer story remains fuel supply. California's system is harder to backfill. EIA said the West Coast has limited logistical connectivity to other refining hubs, including the Gulf Coast. EIA also said the shortfall left by the Los Angeles and Benicia refinery exits is likely to have an outsized impact because it cannot be easily filled by other refineries elsewhere in the country. This is the difference between a fuel system with options and a fuel system with constraints. If a region can quickly replace lost production from nearby sources, the consumer impact may be limited. If a region has fewer logistical connections and depends on specialized fuels, the impact can become more significant. California's CARBOB requirement is part of that complexity. EIA noted that California's unique gasoline blend stock can only be manufactured by properly equipped refineries. That does not mean replacement supply cannot exist. It means the supply chain is more specialized. A specialized supply chain has less flexibility than a generic one. For drivers, that can mean more vulnerability to volatility. The companies offered supply plans. Phillips 66 said it would source gasoline from inside and outside its refining network. Valero anticipated importing additional gasoline volumes to the Bay Area in the near term. Those details show that closures do not automatically mean an immediate absence of fuel. But importing and sourcing from elsewhere is not the same as having the local refinery still operating. The system changes. The region becomes more dependent on replacement flows. That is where household risk sits. A driver does not care whether a gallon of gasoline came from a local refinery, another domestic source, or an import if the price is stable and supply is reliable. If the replacement system is tighter, slower, or more exposed to volatility, the driver can eventually feel the difference. Refinery capacity functions like a hidden cushion. Most people see the pump price. They do not see refinery units being idled. They do not see the final crude shipment. They do not see process units taken down in phases. They do not see the difference between 2% of national capacity and 17% of state capacity. Those details shape the supply environment behind the price. The National Inventory Forecast adds another layer. EIA projected that inventories of motor gasoline, distillate fuel oil, and jet fuel would fall to 375 million barrels by the end of 2026, the lowest since 2000. EIA tied that to two pending refinery closures and growing consumption. EIA also provided nuance. Its national forecasts did not mean all retail prices would rise equally. EIA noted that falling crude oil prices could partially offset wider margins, leading to smaller retail fuel price increases, or even a decline in retail gasoline prices in its forecast. That balance matters. The accurate claim is not that refinery closures automatically create a uniform national price spike. The verified claim is that closures reduce refined product output, shrink inventories, increase regional vulnerability, and can increase price volatility, especially where replacement supply is harder to source. That explains why drivers may pay the price without overstating the evidence. The escalation is visible in the timeline. Marathon's Martinez refinery closure in 2020 appears in EIA's account of declining West Coast capacity. Phillips 66's Rodeo refinery ended petroleum refining operations in early 2024. Phillips 66 announced plans in October 2024 to close the Wilmington refinery. EIA warned in March 2025 that U.S. transportation fuel inventories were forecast to fall to their lowest levels since 2000 in 2026. Valero gave notice in April 2025 regarding Benicia. EIA reported in July 2025 that California was set to lose 17% of refining capacity over the next 12 months. Phillips 66 received its final waterborne crude shipment at Los Angeles on September 30, 2025. Final crude processing was expected around October 16, 2025. Remaining units were to be idled through the end of 2025. Valero proceeded with phased idling in early 2026. Argus reported on April 30, 2026, that Benicia had stopped producing fuels. This is not a single announcement. It is a pattern of capacity leaving a region already limited by geography, logistics, and specialized fuel requirements. For households, the pattern matters because repeated capacity losses reduce resilience. A fuel system with more local production has more tools. A system with less local production needs more replacement supply. If inventories are already forecast to fall, and if closures represent a significant regional share, consumers can become more exposed to volatility. That exposure does not always appear as one dramatic event. It can appear as higher pump prices, sharper regional swings, greater sensitivity to outages, more dependence on imported barrels, or tighter market conditions when demand is strong. The driver may only see the final number. The family may only see the receipt. The pressure began earlier, when capacity left the system. Refinery closures do not have to be visible to be important. They do not have to dominate national capacity statistics to affect a regional market. They do not have to create immediate shortages to make the system more fragile. They reduce the cushion. When the cushion is smaller, surprises become harder to absorb. The latest verified status shows the issue clearly. Phillips 66's Los Angeles refinery had received its final waterborne crude shipment on September 30, 2025, with final crude processing expected around October 16, 2025, and remaining units scheduled to be idled through the end of 2025. Valero proceeded with idling Benicia through early 2026, and Argus reported on April 30, 2026, that the refinery had stopped producing fuels. EIA said the closures removed 17% of California refinery capacity and 11% of West Coast capacity, creating a risk of higher fuel price volatility in the region. Nationally, EIA forecast that inventories of motor gasoline, distillate fuel oil and jet fuel would fall to 375 million barrels by the end of 2026, the lowest since 2000. AAA reported on May 7, 2026, that regular gasoline averaged $4.55 per gallon nationally, up 25 cents for the second consecutive week and $1.40 higher than 1 year earlier. These facts do not need exaggeration. They show a fuel system losing refinery capacity in a region where replacement supply is harder to source. They show a national forecast for transportation fuel inventories falling to a multi-decade low. They show falling gasoline inventories in the latest weekly market context. They show drivers already facing high pump prices. The unresolved pressure is not only the closure of one facility or another, it is the smaller supply cushion left behind. For ordinary people, that is the real story. A refinery closure begins as an industrial event. It becomes a capacity loss. Capacity loss can become lower inventories and more dependence on outside supply. Lower inventories can increase competition for refinery production. That can place pressure on wholesale and retail prices. Retail prices are where the household feels it. A family may not follow refinery capacity reports. It may not read EIA forecasts. It may not know the names Wilmington or Benicia. It pays for gasoline, diesel-linked freight, deliveries, groceries, commuting, school transportation, and the daily movement of goods. That is why America losing refineries matters. The loss of refining capacity can travel through the market until it reaches people who never saw the closure happen. Drivers may pay the price, not as a corporate headline but as a fuel receipt, a higher weekly fill-up, a delivery cost, a grocery bill affected by transportation, or a household budget with less room for another increase. The fuel system works best when it has cushion. Refinery capacity is part of that cushion. Inventories are part of that cushion. Regional logistics are part of that cushion. When those cushions become thinner, the consumer becomes more exposed. America is not only watching fuel prices move, it is watching part of the fuel supply system become more fragile. For the people at the end of that system, the consequence is measured in the cost of getting to work, the cost of moving goods, and the cost of keeping a household budget stable when the fuel market has less room for error.